Hey there, homeowners and potential home buyers. This is Amir, Syed with your Mortgage Minute. Today's video is going to be about credit, which is a very important subject. Credit is going to follow you everywhere you go. Whether you're looking for a car, whether you're looking for a home loan, whether you're looking for new credit cards, that credit score is super important in the cost of borrowing. So I'm going to speak very briefly on some major bullet points that are important for you to understand credit and how to keep a good credit score or to increase your credit, okay? So the national credit score average is 687. The credit range is between 300 to 850. It's very difficult to get 850 and it's very rare to have a credit score as low as 300. So many people are hovering right around 687. How to essentially understand how credit is basically comprised of. So FICO, F-I-C-O, is shortened for Fair Isaac Company. They are a predictive analytics company that basically extrapolates all data that's based on your type of borrowing habits and is used by different lenders to understand what your credit risk profile is, and it's pretty much based on a score, okay? So how is that all comprised? 65% of your credit is based on payment history and credit utilization. So what does that mean? Of course, history is very simple. The longer you've had credit, the more that the predictive model can assess what your score would be. And then secondly, credit utilization is, are you actually utilizing credit, and are you utilizing in a prudent fashion? Are you keeping your balance to limit on your credit cards low? Are you essentially paying your payments on time? Things like that. 15% is a length of history. The longer you've had better credit, the better is your score. 10% is type of credit, the credit mix or credit diversity. So for example, if you have some student loans, you have some credit cards, you have some one car loan, a mortgage loan, installment debt, the more diversity there is to your credit, it actually helps with the credit scores. And finally, 10% is new credit. So as you apply for new credit, obviously if you're getting approved for new debt, it helps your score, but you have to be very careful here. It's almost like a catch-22. You do not want to apply for new credit oftenly. So you don't want to go and apply for 5 new credit cards in 1 week. So what I say is once or twice a year, call your credit card companies, see if they can raise your limit. Go out there, get one new piece of debt every single year to add to your credit mix, but that's exactly how it's all comprised. So what I'll say is if your credit is not good, it's below the national credit score average, just know the beautiful thing with credit is it's a living organism. You can always do things to it to have it improve. It's not permanent. Go out there, pay your collections. If you have a lot of credit card debt, start having some psychological wins and start paying some of the smaller credit cards off. And then once you do that, go out, celebrate a little bit. Debt and is a lot of emotional type of decisions. So as you pay those things off, your credit will get better. Celebrate. Last thing I'll say is to get mortgages, 620 to 680 is considered below average credit, but you can get a mortgage. 680 to 720 is considered good. Anything above 720 is considered excellent credit. So it's going to basically control essentially what kind of interest rates you're getting. So reach out to us. Even if you're not getting a home mortgage, we'll be more happy to help you and guide you. Visit myfico.com. Check your credit at least once a year. It's important to always stay on top of it, okay? As always, have fun, get the knowledge, ask the questions, and teach some of the younger generation after us and after you how to manage your credit as well. A lot of them are really ill-advised, and it's super important. Hopefully this helps. Please feel free to reach out to me anytime and keep those credit scores up, okay? Talk to you soon.